Hey, welcome back to another weekly wealth walk. This is Jerry Fetta. I want to talk to you about the biggest mistake I see accredited or semi-accredited investors making and why they make it and what to do differently. Stay tuned. Hey, Jerry Fetta here. Welcome back to another weekly wealth walk. So I'm here just doing a quick stroll this evening. Beautiful night out, and I wanted to hit you guys with a video. I had a conversation with someone yesterday. They're an accredited investor. Okay, if you don't know what that means, an accredited investor is someone that's got $1 million net worth or higher. And so they were that, and they were looking at doing some different investing, right? Now, like you and like me, they came out of the Wall Street system. Normal, traditional retirement accounts, 401ks, IRAs, you name it, right? And so they're coming out of that environment and they're starting to look at different asset classes, things like real estate and precious metals and life insurance and other things that the top 1% have historically used throughout history that we're not really taught to use because Wall Street does not make that much money on those things. So they offer different stuff, right? It's harder to pull as much money multiple times as possible out of a real asset. If you've got, an oil field or a piece of real estate or a piece of gold, you can't hypothecate or create new securities and new securities and new securities, these various different investments. Like you think about 2008, they did mortgages. So the initial mortgage, that's already an investment. Then they sell the initial mortgage to Wall Street, to an investor. The investor then sells it to a fund. The fund then sells it to a pension or 401k plan, which then sells it to the employee or the end user, right? There's like 3 or 4 layers of different investments, right? So you can't do that as easily with hard assets. So when you think about like how many times can someone get paid on a Wall Street transaction? Well, if they keep kicking the can down the road and kicking the deal down the line like that, they can get paid 3 or 4 times on the same thing. So you can't do that with hard assets, right? But that's kind of just his own little bunny trail, my own little, explanation of how that works. Let me take a break here. Beautiful today. This person, they were starting to look at, there you go, look at that, guys. They were starting to look at these hard assets, and I saw them making the number one mistake that most accredited investors make. That mistake is diversifying. What do we hear from Wall Street? Diversify, spread your risk out. So when I was a financial advisor, getting trained up, brand new in the industry, I was taught that diversification was like a windowsill. You've got, panes in the window, and if you're playing baseball, and one of the balls goes through the window, if you don't have window panes, the whole window shatters. If you do have window panes, only the pane shatters, the rest of the window remains intact. That was what I was taught. And it might make sense to you as you're listening to this. Here's the thing, we're not playing baseball. And so because of the way that works, so does investing. There's 2 quotes I want to give you. One of them is from Andrew Carnegie. You should put all of your eggs in one basket and then watch that basket. So he's saying put all of it in one basket. Well, what's the thing we're taught by who? Who told us this first? I want you to think about, where did you first hear about this? Don't put all your eggs in one basket. Be good enough at baseball that you don't hit windows. And if you're not gonna do that, you probably have no business investing, and you're not someone that would be watching this video. If you're the normal, consumer, retail purchaser of mutual funds and stocks, you're not someone that's watching a video on how to build wealth like a top 1%er and how to run your wealth like a business. This is not your content. Now, if you are that, you don't want to spread yourself thin like this. If you think about it like a business, not like investing, because Wall Street and banks, I promise you, they look at all this stuff like business. They don't look at it the same way they're telling you to look at it. You're looking at it like it's your security and it's your retirement. They're not. They're looking at it strictly like a business. And if you don't run your wealth similarly, you're not going to do it the same way they do it. And they're the ones that are making all the money on this stuff. So if I look at it like a business, if I have a business that sells one product very well, all of my staff know that product or that service. We've trained them on it. They're all competent. They're doing really good with it. And all of a sudden I'm like, let's start doing 10 different products and services. Why? Because if that one goes down, we want to sell 9 other ones just in case. I can tell you, and if you work in a company, whether you're an owner or an employee, the more things you offer and deliver, the more confusing it is, right? That's just how it works. So if you have 9 products, that's 9 different things you have to train people on. That's 9 different offerings that your guys have to understand and be able to sell and market and deliver. And it becomes very confusing and very complex. Versus if you have one product, McDonald's, right? You get the burger and fries as they're offering, burgers, fries, and a Coke. Or a pizza shop, like we make pizza, You're not there figuring out, well, what if the pizza doesn't work? Well, let's make burritos. No, if you're not selling pizza, you need to figure out why that business is not offering the pizza and delivering the pizza the way that it should be, not dive into burritos. Do you see how this is different when you think about it like a business? So the idea that, okay, well, what if this asset class goes down? And here's the thing, when you diversify, and this one's from Mark Cuban, also a billionaire, a top 1%er, diversification is for idiots. It is for those who do not know what they are doing. So if I see someone diversifying, what does that tell me? It tells me one of two things. They don't know what they're doing. And so they're like, okay, well, because I don't know what I'm doing, I'm gonna spread the risks out. Well, you don't know how the other 10 things work, do you? This is the thing that took me the longest to understand. I'm in real estate, let me diversify into gold, and let me diversify into stocks, let me diversify into the blue chip dividend paying stuff, and then, you know, the small cap aggressive stuff and the tech stocks. And then I can do all these different companies. When you look at a mutual fund portfolio, you own like 100 or 200 different companies. How well do you understand their financial statements? How well do you actually understand their balance sheet? Most people don't. So you're actually creating more risk because you have things in your portfolio you don't understand and you're not paying attention to. If we made this real estate and I told you, hey, you're gonna buy an investment property, you're gonna know nothing about the property, you're not gonna know the address, you won't know who the property managers are if they've done a good job, we're not gonna vet the tenants, you would never invest in that property. You'd be like, no, I wanna know those things. But all of a sudden, because it's an invisible stock off an invisible Wall Street land somewhere else, we don't need to know who is the company, who are the management, what's their financial statement look like. We just assume all of those things are gonna be okay because it's the stock market. So diversification, number one, happens because someone doesn't know what they're doing. Number two, because they're distracted. Okay, when you run a business, when you see an executive, a CEO, an owner, randomly adding a bunch of product offerings, it's either they don't understand the one that they offer and it's not working because they don't understand it, or they're distracted. They have shiny object syndrome. And I see investors doing this also, where it's like, ooh, I wanna put money in that. Ooh, I wanna put money in that. That sounds good. My friend is doing this. The water cooler advice at work, or the guy online is telling me to put money here. Both of those are evidence that you've not mastered one investment. See, you don't diversify, right? So I'm a simple guy. I wear clothing that I like. I wear clothing that I understand. I wear clothing that fits me personally. Okay, I wear stuff that fits what I'm gonna use it for. I'm hiking right now. There's cactuses. I'm not gonna be out here wearing flip-flops. I'm wearing shoes. There's thorns. Fits my purpose. Okay, so it fits the purpose, the thing I'm using it for. I'm gonna wear clothing first that's vital. Okay, I'm gonna put on underwear before I put on a $300 Gucci belt. I'm not gonna be out there, you know, with my belt and no pants on, missing my underwear. I'm not gonna overpay, so there's a difference between price and value. So I'm not the guy that's probably gonna spend $300 on my Gucci belt because I don't see the value in it. It doesn't do anything for me other than maybe make me look cool in front of all the other broke people. I'm gonna wear clothing that I control. I don't want someone taking my pants away when I'm walking down the street, right? I don't want them to be like, hey, you're renting and you didn't pay. There goes your shoes. So same would go for investing. I'm gonna invest in stuff that I like. Do you really like every single company in your stock portfolio? Do you really like all the things that you're being told to buy by your banker or your financial advisor, or are you just going with what they say? Number two, you've got to understand it. Back to the thing of the balance sheets and the financial statements and the management. If I was asking you for money to invest in my business, you would want to get some questions answered, wouldn't you? Why don't we do that with retirement money? Why don't we do that with the Wall Street investments that we're so easily putting cash into? So I need to understand it. The investment needs to be something I know. Next, the investment needs to fit me personally. Everybody has a different risk tolerance, what they're comfortable with, a different investor personality. You can look at this as from person to person. I have a friend, he's very into angel investing. That's his game, he loves it. Me? No, I don't like it. I'm not into angel investing. I'm not an angel, I'm an investor. Okay, I wanna make returns, not, have a bunch of maybes and pie in the sky that, maybe one day the one winner will make up for all the losers. I'm not into that. That's not something that fits me. The investment needs to fit your goals. That's your fourth step here. It needs to fit your goals and purposes. What are you using it for? For 90%, probably 95% of Americans, and if you're watching this video, your investment for a long time needs to produce residual income. It needs to be producing residual income. It means money that you get paid for that you didn't work for. You get paid each month with that, right? And that's residual income. So if your investment's not producing that, you got to keep trading time for money. So the thing it produces for you is how you measure its performance, not did it go up or down. It's I need it to produce income that I don't trade my time for newly each and every month? Does it do that? And if it doesn't, that investment, even if it's like, oh, it went up, it doesn't produce the thing I need. You see that? So it needs to produce the things you need, your goals, your purposes. Next, it needs to be vital. So invest in things that have been around 100 years and are gonna be around 100 years. That's my philosophy. So I'm not investing in the latest up and coming thing. I look at the same way Bezos runs Amazon. What do we know is gonna be around in 100 years from now? What do we know people are still gonna need? They're still gonna need currency, and they're still gonna need money. They're still gonna need energy. They're still gonna need housing, right? They're still gonna need insurances. And these are things that have also been around 100 years. So as much as you guys might not like to believe it, some of you, we're gonna need oil. I think there's a better way we can go about using it and getting it, but it's not gonna just go away. So those are things that I know are vital. Next is the price value question. It can't be overpriced. Price is what you pay, value is what you get. So if I'm not getting more than I pay, I'm not gonna invest, right? And so I wanna make sure that I'm getting more than I pay, and I need to be able to measure those things. I need to know, how do I figure out the value on a real estate deal? How do I figure out the value on oil and gas? How do I figure out the value on life insurance? So some of this goes back to the knowledge. Can't be overpriced. Final thing, I need to have control. I need to have control of whatever the asset class would be, whatever the investment would be. So if it's real estate, for example, I can have control through direct possession of the property. That's my house. Okay, if something happens, if the person doesn't pay, I can take it back. There's control there. I can also have control through management and regulation. So let's say someone else's business, it's a small business that I invest in. I'm not gonna be able to like go in there and like take stuff, right? Or be like, those are my burritos, like in the burrito shop example. No, but I can have control through management, oversight, regulation, paying attention. So these are the things that you would check off when you're looking to invest. This is the stuff that I look at. This is the stuff the top 1% looks at. And if you really can check these things off for each and every item, you wouldn't need to diversify. In fact, you wouldn't want to, because you would want to answer these questions. And I would venture to bet anybody that's investing in exchange traded funds or mutual funds or diversified portfolios isn't actually capable of answering these questions, all of them, on every single company, every single holding, every single asset you own. It'd be too much work. And even if you could answer them once, by the time you finished answering for all of them, you'd need to go back to the top and start over again, because so much time had elapsed. So that's my wealth walk today. If you're watching this and you're an investor and you are not answering these questions with your investments, and you have been looking to diversify because you are either in the I don't know category or the distracted category, which is just another symptom of the I don't know category, I want to challenge you. Think about this. Be a CEO when you look at your investments. Don't just be the retail consumer buying the McDonald's financial products. Because that's what it is. You're going through the McDonald's drive-through of finances, and you're ordering a number 6 with fries, right? And that's not how investing is done. That's not how wealth is built. So I want to challenge you to use these concepts. I know this was a bit of a longer video, but this is a really important topic to me. And if you have questions about this, you can grab my book, you can reach out, you can comment, you can connect with me, Jerry@jerryfetta.com. I'm happy to answer questions. I hope that this gave you some value today. I hope you enjoyed my view as I walk, and I will see you guys next time.